If you're new to trading, there's one mistake you should avoid at all costs: risking real money before you understand how trading actually works. The good news is that you don't need to. TradingView includes a built-in paper trading simulator that lets you practice with virtual funds while using real market data and real chart movements. In this video, I'll show you how to use it step by step. You'll learn how to place trades, manage risk, understand the most important order types, and practice in a way that actually helps you build trading skills. And by the end of this video, you'll be able to simulate your first trade without risking a single dollar. Let's jump in. The first thing you'll need is a chart. I'm inside TradingView, and I've opened a chart for Bitcoin. You can use stocks, forex, crypto, futures, or almost any market available on the platform. The process is exactly the same. To access paper trading, look for the trading panel near the bottom of the screen. Click it. You'll see a list of brokers and trading connections. Instead of connecting a real brokerage account, choose paper trading. Then click Connect. After, you now have a simulated trading account connected to TradingView. Nothing you do here affects real money. This is a practice environment. But here's what makes it valuable. The prices are real. The charts are real. The market conditions are real. The only thing that's not real is the money. This allows you to learn without the financial pressure that often causes beginners to make emotional decisions. Before placing any trades, let's take a quick look at the account area. Here you can see your balance, open positions, order history, and account performance. You can also reset the account whenever you want. That's useful because you can test different strategies and start fresh at any time. Now let's talk about reading the chart. You don't need dozens of indicators to get started. In fact, some of the most useful tools are already built into TradingView. One of those tools is the trend line. A trend line helps you identify the direction of the market. Let's find a series of higher lows. Notice how price moves up, pulls back, and then creates another higher low. When we connect those points, we can visualize the trend. This doesn't predict the future, but it helps us understand what the market is doing right now. Many beginners try to guess where price will go. Experienced traders first ask a different question. What is the market already showing me? That's where trend lines become useful. Another simple tool is the horizontal line. This is commonly used to mark support and resistance levels. Think of support as an area where buyers previously stepped in. Think of resistance as an area where sellers previously pushed back. When you zoom out, you'll often notice that certain price levels keep attracting attention. Price reacts there multiple times. Those levels can become important reference points for future trades. Now let's look at one of the most useful tools for beginners: the long position tool. You can find it in the left toolbar. This tool helps you plan a trade before entering the market. And that's something many new traders forget to do. Let's imagine Bitcoin pulls back into a support area. You believe buyers may defend that level. Instead of immediately clicking buy, you can map out the trade first. Place the entry where you want to enter. Place the stop loss below the level that would prove your idea wrong. Then place a profit target above the market. Immediately, TradingView shows a risk-to-reward ratio. This is extremely important. Let's say you're risking $100. Would you be happy making only $50? Probably not. Many traders look for setups where the potential reward is larger than the potential risk. For example, risking 1 unit to potentially make 2 or 3 units. That doesn't guarantee success, but it can improve long-term trade management. Now let's talk about a mistake beginners make. Many people focus only on finding winning trades. Professional traders focus on controlling losing trades. The stop loss is not your enemy. It's your protection. A small loss is manageable. A large loss can damage your account and your confidence. That's why planning the trade before entering is so important. Now let's place our first paper trade. Open the order panel. You'll see several order types available. Let's set with the easiest one. A market order. A market order executes immediately at the current available price. If you click buy, the position opens instantly. This is useful when you want immediate execution. Once the trade is active, you'll see it appear in your account manager. You can monitor profit and loss in real time. You can also add a stop loss and take profit directly from the chart. One thing I recommend is practicing trade management. Move your stop. Adjust your target. Observe how the position behaves. The goal isn't just placing trades. The goal is learning how trades evolve over time. Now let's look at limit orders. Imagine Bitcoin is trading at $100,000. But you don't want to buy at that price. You think a pullback may happen first? Instead of chasing the market, you can place a limit order below the current price. Then you simply wait. If price reaches your level, the order executes automatically. If price never reaches that level, the trade never happens. And that's perfectly fine. One of the hardest lessons in trading is learning that not taking a trade is sometimes the best decision. Patience is a trading skill. Now, let's talk about stop orders. This is where many beginners get confused. A stop order activates only when price reaches a specific level. One common use is breakout trading. Imagine a market that has been moving sideways for several days. Price keeps hitting a resistance level but cannot break through. Eventually, you may decide to enter only if the breakout actually happens. Instead of sitting in front of your screen all day, you can place a stop order above resistance. If price breaks higher, the order activates automatically. This allows you to participate in the move without constantly watching the chart. The same concept works in the opposite direction for bearish breakouts. Now let's cover another important beginner concept. Not every setup will work. Even perfect-looking trades can fail. That's normal. A losing trade does not automatically mean your analysis was bad. Sometimes the market simply moves differently than expected. That's why risk management matters more than prediction. If you can control risk, you can survive long enough to improve. And survival is one of the most overlooked skills in trading. As you continue practicing, try creating simple exercises for yourself. For example, spend 1 week focusing only on support and resistance. The next week, practice using trend lines. Then spend another week working on risk-reward planning. This approach helps you build skills gradually instead of trying to learn everything at once. Another useful habit is keeping a trading journal. After every paper trade, write down 3 things. Why you enter, where your stop loss was, and what you learned. Over time, you'll start noticing patterns in your decision-making. That feedback can be incredibly valuable. Before we wrap up, remember this. Paper trading is not about making fake money. It's about building real experience. The objective isn't to prove you're a great trader. The objective is to develop consistency, discipline, and confidence. Those are the skills that matter when real money eventually enters the picture. So open a chart. Connect your paper trading account. Choose a market. And start practicing. The more time you spend learning in a risk-free environment, the more prepared you'll be when it's time to trade live. If you found this tutorial helpful, make sure to subscribe for more TradingView guides, trading education, and beginner-friendly market analysis. And let me know in the comments, what's the first market you're planning to practice on using paper trading? Thanks for watching, and I'll see you in the next video.